It is October 10th, 2014, 12 p.m. Eastern Time. I'm here with Richard Weissman of WeissmanSignals.com, and we are here for a series continuation. Today's documentation is on frequently asked questions. Richard, how are you doing?
Good. How about you, James?
Doing great. Thanks very much. We've got some action in the markets. Good to see that, isn't it?
Yeah. You know, it's nice to have a two-sided market in equities and equity indices. So it's been interesting.
Absolutely. Well, let's get started here today, shall we?
Yep.
So we've got a few questions here that comes with the subscriber package upon the welcome. First and foremost, Richard, what is the signal sheet?
Okay, so let me actually just show people hold on one second. Let me show people what the frequently asked questions document looks like. Okay, do you see it now?
Not yet.
Okay. Let's try it again. Okay, let's try now. How's that? Are you seeing it now?
Not yet.
Okay, so do you have the ability to pull it on your side? I'm not sure why you're not seeing it.
Yes, I'm
okay.
presenting it.
Perfect. Okay, so now let me just do something on my side, and we'll get started. So as you could see, there's a document that's being sent to our subscribers when they subscribe called Frequently Asked Questions that I created in order to answer typical questions that would arise when people first started trying to navigate through the signal sheet. And so the first question you already said, right, was what is the signal sheet?
Yes.
So it's an educational add-on tool that basically is an add-on to my book, Trade Like a Casino, and it's based on two swing trading models. So swing trading meaning that you're going to hold your trade anywhere from 2 to 10 trading days, and both of the models are based on the cyclical nature of volatility as outlined in Chapter 4 of the book. So the main model is trying to capitalize on breakouts from a low volatility environment, and then there's a secondary counter trend model that looks for mean reversion in a high volatility environment, and it has a long-term trend following filter so that it can only take signals in the direction of the longer-term trend and counter to the high volatility short-term counter trend.
When you say mean reversion, what exactly do you mean by that?
That means when something gets too overbought or too oversold, that it's going to revert to the value area or the middle of the price of the recent price range. Just like a rubber band, when you stretch it too far, unless it breaks, it's going to bounce right back to its normal level of this.
Okay.
Yeah.
So essentially, the signal sheet is a comprehensive method to categorize two separate methods of market behavior.
Yes, right.
Excellent. Can I learn many of the tools that are used by Weissman Signals Incorporated?
Right. So this question comes up quite often is people say, I want to learn how you get the signals that are in the signal sheet. And although I won't give away the exact entry and exit criteria, I will teach people via one-on-one private consultations the dynamics that are driving the buy and sell signals, as well as how we may manage trades once you get a trading signal. In other words, how you manage risk, and then how you manage the position once it goes in your favor. And that occurs, I do that through private consultations. It's not cheap, because I also do this for institutional and commercial entities like Fortune 100 companies and hedge funds. But if you really want to learn this stuff, I do private consultations, and you can do it.
And what's the most common method that you offer those one-on-one consultations?
Most people want to do it via the phone, because if they want to do it where I'm flying out to them, then they've got to incur travel expenses. So individuals that want consultations, it's all over the phone. But when large companies hire me, they will fly me out to their site and pay for my hotel and meals and everything. And
let me ask you this: is there a number that Weissman Signals you can contact?
Yeah, I do have a phone number that's been set up for the signal sheet, and people are welcome to call it. It's 727-808-4190. But in all honesty, internet age, I'd say 99.9% of contact with me is done via email, and that email is richard@weissmansignals, WEISSMANSIGNALS.com.
Excellent. Moving on to another question that is common. What is your opinion on trailing stops? I've seen some traders speak against them, arguing that a trailing stop may take you out of position too soon, since the stop will follow the price in real time.
Right. So I've heard this. I've heard things about using stops, period, or using trailing stops, and people think that professionals are gunning for their stops, and we absolutely use trailing stops. We use risk management stop losses always. You'll never get an entry signal from the signal sheet without a risk management stop. And then the risk management stop, once the market goes in our favor, will be replaced by a trailing stop. And our opinion has always been that if the market is weak enough to hit our stop, then we no longer want to be in that position. We'll just move on to the next position.
So you do not abide to that belief that institutions are hunters of stops?
Yeah, I mean, maybe they are, maybe they aren't, but I don't know how to make money without using stops. Because basically, if you think about it, if you were to flip a coin, and every time the coin came up heads, you got $2, and every time it came up tails, you would lose $1. The only thing that prevented you from losing dollar after dollar after dollar after dollar was that you had some type of mechanism that said, okay, so once I lose $1, then I no longer will flip coins until it has proven that it can come up heads again. It's probably not the best example, but the general idea is, in a positive expectancy model, the only thing that can dismantle that model is failure to manage the risk, and the only way to manage the risk is with a stop loss.
So it's safe to say that you don't necessarily care about what they're doing. You only care about managing your own risk.
Right. Right.
Yeah.
I mean, in a large enough statistical distribution, everything's going to happen. You're going to see trades where they miss your stop by 1 tick, where they take out your stop, and that becomes the low of the day, and everything else, And who cares? Overall, we have a positive expectancy model that can only be dismantled by failure to manage the risk, and the only way to manage the risk is stop losses, so we use stop losses.
Excellent. What generates a trend following signal, and what generates a mean reversion signal?
Okay, so this is probably the most common question that's ever asked of me. And the answer is, of course, that it's proprietary. Even if you do a private consultation, I'm not going to tell you the exact parameters that are driving the models. But I will tell you that they are generated by volatility indicators. And a trend following signal will occur when the indicators signal low volatility, and a mean reversion or counter trend signal will occur when the volatility indicators signal high volatility, and then the asset reverses direction, confirming the reversal from the high volatility reading. And again, you can learn more about volatility signals in Chapter 4 of the book, Trade Like a Casino.
If I may, in its simplest form, would you say that you could measure volatility from considering a session's range or something along those lines, a week's range or a month's range for that matter?
Yes, everything that we're using to measure volatility is derived from the price of the underlying. So we're not really looking at implied volatility of option premiums, which is the other way to measure volatility. So we're looking at the asset's volatility over a historical look-back period. Absolutely.
Excellent. Are there rules of entry, exit order type, etc.?
Yes. All entry signals are generated by stop limit orders. So they require the market to prove that it is strong enough to generate a buy signal or weak enough to generate a sell signal. And all exit orders are either exiting with profits based upon a limit order or a trailing stop loss order. Now for the trend following breakout signals, these signals are generated from low volatility, as mentioned before, and then once generated, once the signal is generated and trade is generated, we place a buy stop limit above the market and a sell stop limit below the market, so that they sometimes call this bracketing, so that if it's strong enough to rise, we buy, and if it's weak enough to fall, we sell. Once we're in the market, because it did rally strong enough or because it did sell off weak enough, then we place a protective stop loss order either at the prior day's high or low, if it's a buy, or the entry day's high or low. Then, once we have a statistically significant unrealized profit in the trade, we will move our stop to a minimal profitable exit level. In addition, we'll try to exit with a limit order anywhere from as low as 20% of the position to as high as 80-90% of the position at a logical, profitable support resistance level. And the remainder of the position will be exited via a trailing stop, usually placed at prior day's high or low.
So now if I may real quick, on the trend following, if you're buying and ultimately you're putting the protective stop loss order, you're going to use the prior day low. And if you're selling, you're going to use the prior day high. Is that a correct clarification?
Almost always, yes.
Almost always. Okay.
Yeah. It could be that that the trigger, when the market finally triggers, that we were using the low originally from 3 days ago or something like that, and so on entry day it'll be the 3-day low, but as soon as you get the 6 p.m. update, it'll switch to either the prior day's low or the entry day low. If we don't have a statistically significant unrealized profit, in which case it would switch based upon that criteria, a little bit better than break even and exiting with the limits.
Okay, so there is a time frame in which the stop might not be directly at a prior session's vice versa extreme.
That's right.
In particular, that takes place on entry day.
On entry day, yeah.
Okay. And for the counter trend signals?
Right. So these are generated from a price reversal accompanying a high volatility reading And then once the asset signals high volatility, we'll place a stop limit order to enter at the prior day's support or resistance level. Once we're in the market, we place a protective stop loss order at the prior day's high or low. And once we have a statistically significant unrealized profit, we'll move our stop to a minimal profitable exit, and also we'll exit anywhere between 80 to 20% of the position with a profitable limit order at a logical profitable support resistance level. And often, and this I will give away, this level is the 18-day simple moving average. The remaining 20 to 80% of the position that's not being taken out at that moving average will be taken out with the trailing stop.
Excellent. Sometimes the signal may be missed in less liquid assets because the price gaps through my stop limit entry order. Do you suggest entering the trade any differently?
Okay, so the beauty of the signal sheet is that it always assumes that you're trading at least 2 units, 2 contracts if it's futures, you know, et cetera, et cetera. So for the lower liquidity assets like cotton, coffee, live cattle, lean hogs, since you're trading at least 2 contracts, you could buy or sell one with a regular stop order, and then a second one with a stop limit order. That way, if the market runs and gaps away, at least you get 50% of your position. And if it does back and fill, at least you'll get 50% at the stop limit level. But, of course, that stated, the signal sheet does not do this. It assumes that you're using stop limits. And consequently, if it gaps through the stop limit and never comes back, you'll see the trade disappear. And it doesn't enter as an open order because the signal sheet assumes you never got the fill because you never got your stop limit price.
Your signals seem to make money. Why aren't you trading them yourself?
So the signals that are generated by the newsletter are in fact similar to those that we trade in real time, because our real-time trades are actually a newer build of very similar older methodologies. And the best analogy I've come up with is it's like someone that's selling you their 1-year-old Ford Mustang convertible because they just bought a new Ford Mustang convertible. What do I need with 2 of them, right? I've already got a new one. I'll sell you my old one because I'm only going to drive 1 car at a time. The old Mustang still works, obviously. It just doesn't have all the bells and whistles in the newest model.
What happens if market's opening price is below protective sell stop loss order for long entry or above protective buy stop loss order for short entry?
Right, that would invalidate the signal. If it opens, okay, so let's say we had this order, a stop limit order, and hold on a second, let me just. So let's say that we had a stop limit order in natural gas to buy at 418.4, and we gap above there at 440, right? So that would invalidate the order if we never traded below there again. So you can't take a trade without immediately placing a stop loss order upon entry. Since you gap below the stop loss level, it automatically invalidates the entry signal.
Why does the newsletter come out every evening around 6 p.m. Eastern Time?
Okay, so we're working based upon 24-hour markets. And what all markets do is they use anywhere between a 1 p.m. in the case of sugar to 5:15 p.m. in the case of assets like crude oil and the E-mini S&P as their global close. Once we know what the global close is, then we know what volatility readings are for that trading day. And consequently, we can see if there's new signals, or we can modify existing orders based upon these known closing prices, and we know that the close isn't going to change.
So it's safe to say that you place importance on a full session of pricing behavior.
That's right. Well, it's a swing model, so it's only interested in completed days. In other words, you can get filled intraday,
right,
but we'll only update the model once we have a completed day.
Great. I've been tracking the newsletter for a week, and it doesn't seem to get trading signals in XYZ asset. Why don't you get more signals in that asset?
Okay, so this is how it works. Every asset that's listed in our listed assets document in the welcome package, which we went over last time we made one of these videos, will eventually get a trading signal. What's happening is that the signal sheet is trying to identify an asymmetry in market behavior, a low risk, high probability setup on a swing trading time frame, 2 to 10 day time frame. So we're looking for a very specific type of market action that does not occur often in any particular asset, but occurs in a diverse array of assets almost all the time. And that's why we recommend people that are subscribing to trade the entire diverse portfolio of assets. And when we started the signal sheet in 2010, the assumption was that we were trading 200,000 and that we would take 2 contracts of futures and 200,000 of base FX. And that way you could, do regret minimization, take half off and move your trailing stop on the remainder until you were stopped out. Only trading 100,000, my suggestion is to steer clear of the bigger, more volatile assets like the oil spreads, coffee, cotton, soybeans. Now, fortunately, there is a mini gold contract and a mini crude contract, so you can probably still trade 2 of those mini contracts with 100,000 in an account. And then I would suggest, if you have 100,000 under management, to use 100,000 base FX and treat FX trades as 2 lots of 50,000. That way you can again do the regret minimization. If you're trading 25 to 50,000, then I have a mini portfolio document that I can email you. Just send me an email request, and I'll send you that document.
So it's pretty obvious that this might be important for most traders, but you really focus intently on contract size relative to account value. Is there any excuse for ignoring such a principle?
Okay, so here's what I would say. The big problem with the signal sheet is that I don't have a lot of time. I'm teaching courses, I'm writing books, I'm trading myself. So I wanted to do something that wouldn't take more than 15 minutes for me to update every night. And so consequently, it does not adjust for position size based upon the volatility asset. For example, when we're trading $1 million in the signal sheet, we're just going to take 10 lots of corn. We're going to trade 10 contracts of corn and 10 contracts of crude oil, despite the fact that crude oil is much more volatile than corn. In my real trading accounts, I definitely trade more corn and less crude because corn is much less volatile. And we do advise that real-time subscribers do this as well. In order to somewhat offset that volumetric equality issue, we try not to take multiple signals in higher volatility assets, and we will take multiple signals in lower volatility assets. So, for example, we'll recommend multiple positions in the grains since they're lower volatility, and only 1 position in the petroleum complex since it's higher volatility.
So, rule of thumb, do less in high volatility.
Yes. Yeah. And the easiest way to do that is actually mentioned in Chapter 2 of Trade Like a Casino, and that's the 1% rule. Never risk more than 1% of assets under management on any particular trade. And in that way, if you use that 1% rule, that will keep you dampened down on the higher volatility assets and force you to trade more contracts at the lower volatility assets.
And you just hit on this to some extent, but how do I choose between two signals in single asset class, like metals?
Yes. Now, the way that I do this in real time, if trading all of them were to result in over leveraging and I need to make a decision in order not to over leverage. So let's say I have a signal in platinum and a signal in gold and a signal in SLV, and I can only afford to take one of those signals without over leveraging myself and risking more than 1%. What I would do actually is that I would buy the strongest in the asset class if it was a buy signal, or sell the weakest of the asset class if it was a sell signal. And you could use a tool like RSI to determine which is the strongest, which is the weakest. So if you are using, let's say, for example, a 9-day RSI, and gold gives a reading of 55, and silver is giving a reading of 45, and platinum is giving a reading of 40, you would buy gold, because it's the strongest in the asset class.
Would it be appropriate to assume that the strongest of the asset classes would be that rallies first through a cycle high?
Usually, but I like to use the close, so it could be that it rallies above a cycle high and then closes dramatically lower, in which case it wouldn't be the strongest. RSI, since it's looking at close, to drive what it's quote-unquote calling the strongest, is going to give you a more accurate reading. But most of the time, you're right.
Excellent, Richard. Well, that concludes the content in the frequently asked question PDF that we have here.
So hold on a second. Go to number 12, James. See it? Are you there? You finished it?
Richard?
Yeah.
Did I miss a question?
Yeah. If you go to number 12.
My apologies.
That's okay. That's all right. Are we still live?
Yes. Is there any standard action to take on a trade that gets filled and makes a strong move in the profitable direction before your open trade instructions come out?
Yes, and in the real world I do this. Whenever you have a statistically significant unrealized profit as defined by either the average true range of the asset or Bollinger Bands, things like that, some type of volatility-based criteria, then I would move the stop to a small profit, a little bit above a break-even profit. That way, if you have a big, violent move intraday and it comes right back in your face, you don't get stopped out with a loss. However, the signal sheet is a daily update, so it assumes that you don't have time to watch it intraday, and that you can't move your stops intraday, and so it will continue to play out the trade even though you've got stopped out at break even. Sometimes it'll play out and get stopped out with a profit or take profits, other times with a loss, and you'll get out with break even. But in the real world, I move my stops intraday.
Volumetric position adjustments seem to have positive correlation with strong performance.
Oh, I'm sorry, James. I do have one more point about that before we go on to the next question. A lot of times when people say that you move your stop intraday, so do you take profits? No, I do not take profits intraday. I just move the stop for defense. I do not recommend taking partial profits until the newsletter comes out. That's the whole point to the signal sheet, is we're trying to take advantage of parabolic moves in our favor. by taking partial profits before the trading day ends, you're cutting the profit tail of the distribution, and we do not recommend that, and I do not do that in real time either. Okay.
So you're very seldom entering a market order. You're more of a limit, to say the least.
Yes.
Okay.
That's right.
And once more, volumetric position adjustments seem to have positive correlation with strong performance.
That's right. So basically what we're doing, and this is just a basic rule of risk management as well, that as assets under management increase because of profits, then we will increase our position size. And I use a very, very simple formula. So the volumetric position sizing is mechanically adjusted whenever the assumed assets under management increase by $100,000 on an end-of-month basis. So specifically, we're trading one contract of futures for every 100,000 in assets under management. So for example, at end of month February 2014, we broke the 1.1 million in assets under management, and consequently we increased our position size from the previous 10 contracts to the new threshold 11 contracts.
And it's safe to say that if unfortunately the account were to contract, so too would the contract size.
Absolutely, and we just had that happen, I think, in the month of August. We went down, I think, from 1.3 to 1.2, and so 1.3 million to 1.2 million, and so we adjusted the position sizing assumptions down from 13 to 12, and then just last month, on October 1st, we increased again from 12 to 13 because we went up in assets under management because of profits.
Excellent. Order entry and position management via the signal sheet is a bit complicated and time-consuming.
Right. So we've experienced this question quite often, is that it's just too much for people to handle sometimes, especially, you know, they're trying to work a 9-to-5 job, and it just doesn't, it's too time consuming. And I have arrangements with a couple of brokers that are very well versed in the signal sheet. They know exactly how to trade the signal sheet. And if you send me a private email, I'll be happy to email you our recommended broker list. That stated, remember, it's an educational service. We're not taking responsibility for trading decisions, nor do we take responsibility for the broker that you're using. In other words, if we recommend a broker and it turns out that that broker is, you know, is MF Global, we're not held liable. Instead, our goal, because we don't assume that you're really trading, we assume that you want to learn about how to trade. Our goal in recommending brokers is so that they can augment this educational service and aid in teaching you how the signal sheet works in terms of how it manages risk, how it manages positions.
And with that said, I think it's safe to say that this is a hypothetical, and performance results may have inherent limitations, some of which are described below, have been described by Richard. No representation is being made that any success or profitability will be made. Always do your own due diligence, and again, keep in mind that this is intended for educational use. And with that said, Richard, unless you have anything else, that concludes the frequently asked questions.
That was great. Thank you so much, James.
Yes, Richard, it's good to speak to you again, and
you too.
Hopefully we'll be doing this again here shortly.
Okay, thanks again. Bye now.